I'm going to ask, first of all, to go along the line here and ask, first of all, what it is that you invest in and a little bit about how you do it. So, Heleen, given that you've got a microphone, let's start with you, if we may.
Sure, happy to start. So, Heleen van Poeke, very nice to see all of you, and thank you so much, Esther Company, for having me here today. I wear a few hats, but one of them at my family office, Atlas Invest, is we invest in energy businesses, mostly a combination of conventional energy, oil and gas, but also energy transition-focused businesses, which obviously is all the talk right now, and can obviously speak to some of those trends. But also founded an ESG software business that actually helps businesses across sectors as well as fund managers to really measure their ESG performance in an objective way. So,
excellent, thank you. Ellie, if we could come to you next, if you wouldn't mind. Thank you.
So I do run one of the largest growth equity firms in food, and we are growth equity. And then I'm also actually on the Alaska Permanent Fund Board, which is the largest sovereign wealth fund in the U.S., an $80 billion firm. So I guess I do things from both the GP and the LP perspective, but not actually from any part of my family's capital.
And why food? If you wouldn't mind.
Why food?
Why food?
Oh, okay. So I was born with serious health issues, and while I had a background in leveraged buyouts and private equity, I was watching in the early stages of food investing, it was food tech, and I was watching, honestly, not the health come into food, and my poor little body couldn't digest some of the newer technologies. And I saw a way to be able to use the tools of private markets and actually really build something where it wasn't just for families, but it was a niche asset class where we could be an institutional firm. And as many families know, and especially in Europe, most family offices tend to invest in funds, not just direct deals. And we needed to build a fund that would allow others to come into it. So that's why food. I think we're continuing to see why vertical integration and healthy food companies and regenerative agriculture and ESG are really the key to this. And so, of course, you have to be able to prove out impact, which is where Heleen's been very helpful, but the health angle is crucial. And I've learned from so many of you, there also are health issues, and we really do believe in the power of food as medicine.
We'll talk about proving impact a little bit later on. Esther, given that you're also focused on health, tell me a little bit about your fund, if you wouldn't mind, please.
Yeah, thank you, Tanya. One of the founding partner of THENA Capital, which is seed investing in medical technologies. And so you just mentioned health. My journey came from growth strategy consulting and advising pharma companies, consumer healthcare companies. And when I started mentoring founders, I realized how at that early stage, they don't have expertise about commercialization, go-to-market strategies. They're so focused on regulatory pathway and developing products that they forget that commercialization should be coming, and that slows down their potential for success. So that's why we founded THENA Capital on our expertise in that medical technology sector.
And just a couple of sentences on why is it the direction of travel in that sector has attracted your attention?
I think healthcare is a need everyone has, right? And that will never change. And you have some fundamental unmet need at the moment in the market. You know, I know the UK, I live in the UK, and I know the NHS really well. You know, you have backlogs, you have little support for patients, and it's not because they don't want to, it's don't have the capacity. And at the same time, you have great universities, great minds, and amazing innovation that have the power to solve some of these problems. Over the last few days, you had the London Tech Week. Rishi Sunak, mentioned the power of innovation, and they're really pushing in helping solving some of the problems of society. Climate and healthcare is definitely one. So that's identifying that need, and companies that have power of addressing unmet needs is what we're doing.
Thank you. Lara, over to you. Just tell us a bit about that. You're, of course, different, which is why I left you to last, and that's because you invest in a region in particular. But I'd be interested to know why this region has attracted your attention.
Perfect. So first of all, thank you for having me here. It's been a pleasure learning from the other panelists and from the other participants. So I'm Lara. I'm Brazilian and Swiss, so that is why I invest in Brazil. I run an early stage venture fund out of São Paulo that invests in early stage companies across Latin America. So we're sector agnostic, regionally focused, really leading the pre-seed or seed round, and then taking a hands-on approach with these teams as they scale. Latin America, well, I mean, there's much more problems to be solved in Latin America than there are in Switzerland, to be honest. So there's a lot more opportunity for innovation and technology. And when my co-founder and I started thinking about the fund 5 years ago now, we realized that both of us understood that transformation was coming for Latin America. It was being driven by entrepreneurs and innovation primarily, entrepreneurs, technology, and innovation. And this was being stunted because there was no capital nor support for founders in the early stage. So that's where my thesis came out of, to really lead the first venture round and then take a hands-on approach. So bringing much more than just capital to the table.
Okay, now I'm going to ask you all, if you wouldn't mind, to talk about one investment in particular that perhaps exemplifies your approach. So I don't know who wants to start, but something in particular, some particular company that was doing something really cool and interesting that exemplifies what it is that you're trying to achieve or validates really your choice to invest in this field. Who wants to start? Yeah, go for it.
I can start. So one example is a company in the wound healing space, which is an area in desperate need of innovation. Wound healing, because of bad healing post-surgery or post-intervention, you have patients who have to come back for second, third surgery. You have patients who have to come back for multiple outpatient appointments. And this is a burden. You know, all the healthcare systems want to keep the patient outside of hospitals, outside of the surgeries. And that company that we're backing developed a device that's preconditioning the skin before breast reconstruction. And they are seeing, by improving blood flow, improving dramatically. So the quality of the wound healing. 1 in 5 patients after breast reconstruction has to go back because of troubles with the wound healing. 1 in 3 will be potentially go back onto the to surgery. So you can see right away that there's an impact on the patient, physical and mental health, and you have a drastic impact on the system and how much it costs the system.
Anybody else have a story that they've invested in a particular company and, yeah? Anybody else? Yes, go for it, Laura.
I was going to mention Nocco, but I'll let you take the food one. So, yeah, a great example of a company in our portfolio is a company called KEY. They do car rental for ride-hailing app drivers. So Uber,
sorry, could you repeat that? They do?
Car rental for ride-hailing app drivers. So Uber drivers, basically.
Right.
But in Brazil, we have Uber and 99, an alternative. And basically what we realized when we made this investment, so we met the founder. The founder has a very impressive background, all the qualifications that you would look for in a founder in Brazil. And basically what we understood from the market, so we always look for big problems, right? So the big problem is there are over 600,000 Uber drivers in Brazil, and there are only the largest car rental company, which is a massive company in Brazil. Its entire fleet was 200,000 cars. So it wouldn't even begin to supply cars to these types of drivers. And these drivers are people that are mostly low-income people. They're either in between jobs or they're trying to get a full-time job, and they can't afford to buy a car. And so KEY comes in with a car solution that is tailored to these drivers. They have an IoT in the car, so the car is tracked. They understand how this driver drives because of the IoT, how much he earns, where they live, how much they work. And because they now have so much data on this driver, they can actually start implementing additional solutions. So now they start implementing insurance for these drivers. They start implementing credit for these drivers. and they implement rent to own, so the drivers can eventually own the vehicles. And it's not an impact company. This is a big company that when we invested, they had 2,000 drivers. Now they have almost 30,000 drivers in the streets. In São Paulo, you see them everywhere, the cars. And but it's intrinsically impactful, right? Because you're solving a massive problem. Again, the problem of logistics, the problem of the gig economy in Latin America.
What's very notable about what it is that all of you were saying is that the focus for your investment is quite specific. I'd like to bet you if 20 years ago we'd been having this conversation with different investors, they would be talking about much more eclectic mix. Why is it now, do you think, I don't know if it's a trend in the industry, but that you have this fairly focused approach? Is it so that you can hone your expertise, or is it driven by passion? What is it that drives that very focused approach? Ellie?
Well, look, so they're a little bit earlier stage. So I want to point out, so in food today, and in our 5 years, we've looked at over 1,600 deals. That is over 60% of the industry. Most of them tend to be in early stage. What we do track is what are qualified deals, and we're very clear that qualified does now mean 50 million in revenue.
Right.
You would be pretty surprised how many are even at 100 million in revenue. Now, that's exactly why there's different criteria between Fund 1 and Fund 2. You asked for an example of our thesis. I think for us, and while I guess I get known as being in charge of fundraising, I really look at ourselves as we're product formation experts and capital formation experts, because you have to understand the landscape of where it is today versus not. What was interesting to us when we looked at Fund 1 versus Fund 2 was the only thing that really changed was the revenue threshold, but it was still a bullseye of what we would call food supply chain and improving human health through nutrition. And that keyword nutrition is interesting, and I know Heleen could comment on it. How do you really track nutrition? It's not that easy. It's pretty subjective. My partner Ross calls it, we're in the calorie conversion business. But what does that break down to? It's pretty repeatable, right? We're known for Vital Farms, our signature deal that had $1 billion IPO. 14 months after we invested. It's essentially a category creator. It has a consumer brand, so you're getting that higher multiple, and it's vertically integrated of some sort. We see that now in eggs, in dairy, in beef. That's most of our portfolio construction. However, what's fun is how do you diversify, or what are the outliers? And I point that out because in Fund 1, we had a 20% venture allocation. That venture allocation could return much higher multiples. And so you do have to follow what Lara is doing over there. But it's also tricky when you're not just a venture investor, because remember, their time horizons are much longer than ours, right? So portfolio construction, as well as vintage year, matters just as much as what are the specific investments. And I think that's what gets lost a lot of times, is you can be very sector specific, but if you really go look at why funds are returning capital, a lot of that has to do with portfolio construction, asset allocation, and vintage year, and that gets lost in it. So you have to be, in our case, food investors and nail that private markets component. And so one thing I would say to you all is, I as of a day ago, I know Allison's hearing this, and many of you, I just became chairman of a board, and I was not even a board member of a company called Infinite Health. It was in part of that venture allocation. It is in the microbiome. We truly believe that the microbiome is now out of the venture sector and into ours, which is growth. We get very excited as growth investors of how can we now lean in. We are usually the top on the cap table, and maybe perhaps do a restructuring and bring in the private market experts as well as the biotech investors. And what's very interesting about the microbiome is this is the next frontier of biotech. We get very, very excited about this. So when Lara mentioned Notco, we believe that for growth, it needs to have a consumer channel, which means revenues in. The old biotech meant you just put enormous venture-backed money into it and hope that it wins. In our case, there's commercialization. You have a consumer product, which is a food as medicine product, and then you're also trying to commercialize it as a drug. This is a game changer for those people that really believe in food as medicine.
Great. So let's move to another sector now and talk about energy. Heleen, when you are looking at balancing your investments, and how do you approach that?
I think it's interesting because I think one comment I would make on why do you see more people being sector focused, I think it has something to do with the sophistication of the private market, sort of the private equity industry, right, versus 20 years ago. There are many, many more private equity firms. It's become a really well-established asset class. So I think, that means that what people need to do now to be able to drive value has changed. And so there's a lot more operational sectoral expertise that is required to really move the needle on valuation over the lifetime of the investment that maybe was necessary 20 years ago. So I think part of the sector focus comes from sort of a need to then go and say, what do I really know? Where can I really win? And where can I bring operational expertise? And part of it is, of course, also that I think, to Ellie's point, sectors are really broad. The energy sector is very broad. I think a lot of people don't really realize actually what energy all entails and all the different types of energy. Even within oil and gas, there are obviously upstream, midstream, downstream. I mean, it's like those are categories in itself. So I think the way we think about it is, we're focused more on mature technologies because we just believe, look, we're not necessarily technologists. We're not going to be the ones who are going to, understand what technology bets we need to make. We've done that in the past. That's maybe also where we haven't performed as well. But what we seem to do quite well is get involved with companies where there's a proven business model, where we can bring in our larger energy network, either, to help foster commercial agreements, bring in the right management team, bring in our own portfolio management expertise, bring in investors, banks that are looking at this sector. But even, of course, within that, our diversification is more across, I would say, what I earlier referred to as conventional energy and the energy transition. Obviously, the energy transition implies that a lot of conventional energy businesses might not have a right to exist anymore, in the future. I think, my conviction is that we will need to rely on some of those energy sources for longer than most people probably would like, because unfortunately, some of the other technologies that are supposed to supplant conventional energy are not necessarily available at scale yet.
Thank you very much indeed. Lara, if we can come to you and ask you, it's not just Brazil that you invest in, is it? It's Latin America as a whole, right?
Yeah, so we have 40 portfolio companies this far across 5 countries. 60% of the investments are Brazil. 40% are between Mexico, Chile, Colombia, and Argentina.
Right. And how do you balance the risk within that region? Because if you hear Latin America, you're thinking about currency risk, interest rate risk, political risk, all of the things that we haven't yet really discussed because we've talked about technologies. That's a very different game, isn't it?
Yeah, I mean, everything that we were talking about here this morning that seems to be happening globally, right? Interest rates, inflation. At the end of the day, I feel like that's news when it happens in the US and in Europe. In Latin America, that's status quo. Like, that's every year, right? We have inflation, we have interest rates go up, interest rates come down. So what we tend to say is that, well, for one, Latin American entrepreneurs are much more resilient because starting a company isn't easy. Starting a company in Brazil particularly is bureaucratically one of the most difficult countries on earth to start a company. So they're naturally resilient. We're much more accustomed to the ups and downs. So we don't get as scared as Americans do, for example, in this last year, when something scary happens. We had a very right-wing president, now a very left-wing president. That happens across the region. Chile is a great example of that. From one day to the next, there was a completely different regime in place. And so this instability, it's almost the status quo. So it affects us less. So what we've seen, and then I think in addition to that, what I'm doing is I invest in technology, right? In technology and innovation, at the end of the day, we're impacted by macroeconomic situations, but at the end of the day, it's parallel, right? We're investing in the new scheme, in what will disrupt the status quo in the old scheme. So what impacts us most in the early stage in Latin America is actually when these fluctuations happen globally and capital restricts, liquidity is restricted, because we don't have a lot of local capital, especially growth stage capital actually becomes very scarce. And that becomes a risk to companies, not in the stage that I'm investing in, but in the stage that Ellie's investing in, except for locally. So later stage, post-Series B, we tend to see a lot more companies struggling as liquidity has restricted globally.
Thank you so much, ladies, for enlightening us this afternoon. Thank you.